Hey everyone, hope they're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's at _finance. And if you want to join our community, finding-value.com. That's where I dive deeper into all these topics, subjects, looking for potential investment opportunities, sharing those opportunities with everybody in the community. I go over them on midweek updates on Wednesdays, and then you can ask questions on the weekend through Zoom meetings where you can interact with me directly and ask me questions, or you can send them to me beforehand. They are recorded and they're uploaded to the website, and you can see previous ones. If that sounds interesting to you, definitely try it out. Special is a coupon code where you can get savings, 50% off the first month only on the monthly membership, and a larger discount on the yearly, and you can always swap from monthly to yearly. All right, Joseph Brown, at least somebody's got a clear mind, a good set of logic on top of their shoulders here. He says the last time we had this many home sellers compared to home buyers was 2014, and look at what it did to prices. So people are sharing this information. They're saying, oh my God, look at the sellers in relationship to the buyers. What this means is that the markets could be potentially normalizing to a more normal level than what we were in this ridiculous time frame, which is basically a billion people bidding for a single home and you can't get anything. This was very similar to back in 2014, and 2014 was not a bad year in the housing market. Now, maybe one could argue, well, this is weakening. We're weakening in the buyers and it's strengthening in the amount of sellers, and maybe they're looking at the trend, but we'll see. We'll see. And it's roughly the same here back in 2014. The only difference I would say is this is trending lower. This is trending, it looks like it's trending lower a little bit. This one was trending higher as this was trending higher too. So this here, 2014, he's got posted, prices went up, not down. So I know there's a lot of people on YouTube, on Twitter, bearish, 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 bearish. It's going to fall. It's going to crash. We've got this huge thing. I don't know, guys. I don't see it in the data. I don't see foreclosures skyrocketing. I don't see bad loans necessarily coming into the system in the same quantity anywhere near what it was like in the mid-2000s. The ninja loans and all that stuff, I don't really see it. People have a whole bunch of equity in their house. I don't know, guys. I'm not in that camp. It's going to take some time for us to get into that camp. And just even if we get a slowdown in the real estate market, which obviously we're experiencing in some areas in the United States, I'm not saying and denying we aren't. But even if we get a slowdown, that doesn't necessarily mean that you're going to see a gigantic home price crash. It doesn't necessarily mean that. So just because we have a slowdown, like 1990, we had like flat to minus 1% home prices here. And that was a recession in the real estate market. And that was like a bad one. There's some other ones that like didn't really impact much. So I'm not in the camp that we're going to get like this minus 20 or 30% pullback in the real estate market. I'm not saying it's impossible, but I just don't think it's likely. That's all. Patrick says, unpopular opinion, focusing on dividends in your 20s and 30s will leave you woefully behind in your 40s and 50s. I think that's complete crap. I disagree. And it doesn't mean that you're 100% focused on dividends. What if you're 100% focused on opportunities and then looking at those opportunities and valuing what you're in? So I would rather own an undervalued dividend paying company than an overvalued dividend paying company or an overvalued non-dividend paying company that is, quote, growth. So Another thing that I've seen is a lot of the companies that I invested in early 2020 that have been huge successes for my portfolio. And I'm talking about the best performing companies in my portfolio. They're all similar to each other, a lot of them. And they went through a progression, like a process or a progressive state. So the ones that turned into 10 baggers plus, some even greater than that, 20, 30 times my money. What I did is I bought when things were really, really cheap. That is number one. Number one is you got to get in when everyone else tells you you are a moron. That's when you want to get in. You get in when it's just flat out dirt cheap. At that time, the financials are going to look crappy. The more than likely you're going to find some other metrics that are very underpriced, which we talk about on the website. And eventually, if they pull out, because these are mainly commodity companies, if the commodity price pulls out of that bottom and goes up a lot, like it did with oil, they go from paying down debt. Well, they revenues increase, then earnings increase, then free cash flow. They all kind of go up together. They pay down debt, they hit debt levels, they buy back stock because generally their stock is undervalued, and then they pay dividends. So those companies that used to pay dividends historically came back to paying dividends today, and you made a 10 plus bagger on it. Are those bad? Are those unpopular? Focusing on dividends in your 20? No, that would be perfect. Let me tell you why it's perfect. So you buy them when they're low. They go through that growth era where they pay down debt, buy back shares, and pay dividends. I am receiving dividends on a yearly amount greater than my entire amount I put into the company itself with my original money. So, for instance, if I put $10,000 into the company to invest, I am now getting $10,000 per year in dividend income from those same companies. Now, it's not every company that is like this. I didn't go 10 plus bag on every company that I put in 2020, and they're not all paying me that amount. I have a handful that are them, a handful that are. And I don't see that as a problem. I see that as the best that's the best thing that could happen to me. And I am actively seeking companies that are early in that process today that will pay me dividends in the future. So am I focusing on dividends? I am. Am I focusing on free cash flow? I am. I'm buying them so out of cycle that they had to cut their dividends. They had to cut everything back. They may have taken on some debt, not huge amounts. We don't want it to have, astronomical amounts of debt. And I think that's a perfect thing to do. I think it's smart to focus on companies that can grow cash flow, grow dividends out in the future, and you get a big fat return. You might get a 4, 5, 10x when it revalues itself in a better market condition, when the commodity price goes up. So I think this is complete hogwash. You know, in order to become a really good investor, you need to know the game you're playing. You need to know the boundaries. You need to know the rules. You need to know the requirements. And then you need to know things that are right and things that are wrong. And a lot of people throw these things around like focusing on dividends in your 20s and 30s will leave you woefully behind. No. There's other things too. Like when you set up your portfolio and you're setting it up, you don't want to put all your money in these small, risky, speculative companies. It's going to end out with a bunch of diarrhea all over the place. Like it's not going to end well. So if you anchor your portfolio around maybe a few, we'll call it a little bit more stable, a little bit more progressive, like they don't have the volatility maybe, and you're getting some dividends too, it helps anchor the portfolio. It helps anchor your emotions a little bit. It helps anchor things. So is that called focusing on dividends? It is. because it's a part of the portfolio. You're focusing on aspects and traits to keep you alive and to keep you sane. And if you're able to hold on better using certain companies and the size of those companies, then that's what you got to do. Adam says, getting rich fast has nothing to do with luck. Here's the blunt truth. Find people older and wealthier than you, earn their trust, make them want to help you. Absorb every word they say. Don't overthink, just act. Drop the ego, forget trying to impress anyone. Execution beats originality in the beginning. Innovation is for when you've already won. Stop trying to reinvent the wheel, master the basics first. I mean, is this guy really trying to act like he knows all what's going on? Do you know how difficult this is for a lot of people? Getting rich fast. Well, define what fast is. Are you talking like a couple of years? And it has nothing to do with luck. No way. That's BS. I call BS on this. So most of the people that I know that have gotten, quote, rich, and let's define what rich is. Let's just say 10, 20 years ago, when I was younger, let's say I'm graduating high school, and you want to get rich more quickly than others. So you're in high school graduating, or you're graduating college. Let's call it about 20 years ago for me, roughly speaking. Back then, I would have considered rich people to have over a million or $2 million net worth would be very rich. The only people I knew that had a million or 2 million plus were all 40 plus years old, all of them. They were 45, 50. I didn't know anybody in their 30s that was ultra wealthy, killing it. I knew no one. So everyone that I knew growing up, at least in high school, were like my friends' parents and stuff like that. And some of them were, I would consider to be pretty wealthy. My parents, I thought, were successful, and a lot of the people that I played sports with and hung out with, I would say a lot of them were pretty. They did things, right. But nobody got rich fast. And when I mean fast, it wasn't like you graduated high school. I don't know anyone from my high school that made over 5 million bucks within 5 years of graduating high school. I don't know anyone. From college, I know one or two people that made probably that had a net worth over $1 million 5 years out from college. Maybe a couple. One and the only thing that were similar between them is they all opened up their own companies. That's the only way that I could see you could do it quickly. But here's the thing. When you're coming out of high school, you're coming out of college, you have no money. So you're going to have to borrow a lot of money. You're going to have to take on a lot of risk, potentially. And I think it's way easier today than it was back then, because we didn't have the internet. Some of the internet was growing, like YouTube was getting big, and even the internet was kind of getting big. And, cell phones just came out in 99, 2000, 2001, like in that general area too. I think it's a lot easier today than it was back then, because you can start things and ramp it without the money requirement. But I just don't see many people doing it. So getting rich fast has a lot to do with luck. It has a lot to do with being in the right place at the right time. Becoming a billionaire, it has everything to do with the market conditions. You're in the right location at the right time, building the right products, and that's how you become a billionaire. I would say getting very, very wealthy has more to do with luck than it has to do with skill. Yes, there's a lot of people that are very skillful, but you also need to be in the right place at the right time, and things just need to come together. That I would say that's also true for sports, even for sports, for being a professional race car driver and winning championships. It's everything in life. Luck has far more to do with a lot of things than what people think. I'm not saying that skill isn't required, which it completely is, but they also need a ton of luck with skill. So it's all dependent, a lot of it, at being at the right place at the right time, but you don't know necessarily that you have to be in a certain spot. So if you notice, all of the super rich people today, they're all tech guys. Do you know what the biggest bubble on earth is? It's in tech. So do you think it's just by happenstance that tech billionaires are tech billionaires because they knew exactly where to be at the right spot and the right time? No. If tech is the biggest bubble it's ever been in, then your billionaires are going to be in tech. And back when, like, let's say the 1970s, all the rich people weren't in tech; they were in oil and precious metals and mining and energy and stuff like that. You get these cycles. You have to be in the right place at the right time during whatever era you're in. That's the same thing as Formula One. And I've talked about people too. I think the car and the team matter far more than the drivers. And some people would say, no, that's a driver's game. The cars are so equal. No, they're not. You have end of the pack, mid pack cars, and you've got top of the line cars. There's like 4 teams that are probably capable of winning a championship. That's it. Maybe 4. And in order for a driver to win a championship, you need to be on the right team at the right time, and they need to have the right car. That is it. And if you notice, it's McLaren's the one running it, running the show right now, and Verstappen, who I'm sure he's a good driver. Notice how he's fallen back. It's not him though; it's the team. They lost their builder. Their builder went to another team. I think he's on Aston Martin, I think. And notice how Aston Martin's doing pretty good. So I would say, if it was me, that the team and the car matters far more than the driver. You still need a good driver. They still need to be skillful, but it doesn't matter as much. The gap between cars is greater than the gap between the driver by a long shot too. So a lot of this, I don't believe half the stuff I'm reading here, and maybe that's just from experience. Here's Ray Dalio. I wanted to go through this. This is a good one. He says, I probably would have fired the head of Bureau of Labor Statistics too. That's because its process for making estimates is obviously obsolete and error prone. And there are no good plan in the works for fixing it. The huge revisions on Friday's employment numbers are symptomatic of this, especially because the revisions brought the numbers toward private estimates that were in fact much better. I assure you that this is something that I know a lot about because of how I use data to follow the economy and bet on where it's going. Of course, if the way most people in the media are conveying President Trump's motivation for the firing is correct, such as the New York Times saying when President Trump didn't like the weak jobs numbers that were released on Friday, he fired the person responsible for producing them. That would be a big problem because leaders manipulating numbers that distort the truth to suit their political objectives is a classic sign of the loss of a functioning system with rule of law and checks and balance. And the loss of these things leads to the loss of confidence that underpins our whole economic and political system. So it would be good if President Trump made this thinking clear. In any case, we do need big renovations to the ways that government estimates what's going on in the economy to make them more, not less accurate. So make them more accurate. Now, what he said here, I was thinking that on Friday. Exactly what he said. So let me repeat this really quick. He said, that would be a big problem because leaders manipulating the numbers that distort the truth to suit their political objectives is a classic sign of loss of a functioning system with rule of law and checks and balance. And the loss of these things leads to the loss of confidence that underpins our whole economic and political system. And I was questioning that exact thing on Friday. The, the revisions were so large that I started to question the entire system. I was losing confidence that underpins our whole economic and political system. And it's been getting worse and worse with time. Back in the 90s, 2000s, I was like, I believe this data. No, I believe this thing. Now I'm kind of like, I don't know what to believe. I don't know if these numbers are being manipulated. I don't know if these numbers are so bad that I need to question the entire process of them coming up with it. The EIA, the Energy Information Agency, I think that's what it is, the EIA or IEA, either one, their numbers are just completely off the page wrong. So all these numbers that we're looking at that basically determine and dictate a lot of decisions made by people investing in the markets. I mean, these things aren't even close. The revisions were astronomically large. We're talking like, 40, 50% deviation. This is ridiculous. So, when I'm looking at this stuff, and I read charts, and I have to like aggregate a bunch of different chart patterns to get a idea of what the market is doing now, because all these numbers are jacked. And if someone were to ask me, are we in a recession? I would say I have no idea what the unemployment numbers, like the real numbers, really are, and that will have an outcome on maybe how I weight the portfolio. If we see high unemployment and if it is weakening, then gold and silver would it would continue to go higher. If we see a strengthening in jobs market like we were seeing, but now that's kind of like, wait, that kind of flipped the page there, then we would see more of the inflation sensitive assets look good. But those are all putting in bottoming patterns for their individual sectors. So what's right and what's wrong? I don't know, because I don't know what's going on here. And he needs to come out and say, look, this is what we are doing. This is why I am doing it. Because the loss of confidence that underpins the whole economic and political system, you got to gain that back. Smart Real Estate Bet says the reason home prices flatlined and didn't crash in the 90s is because Volcker did what he needed to in the 80s. That put Greenspan in a position to ease rates significantly as we entered the new decade. Prices didn't need to crash to improve affordability because rates could. I disagree. I agree with the overall message. I disagree that a lot of people say that Volcker did all these things. I think the market forced it. I think the demographic forced rates higher. And Volcker just said, screw it, I'm going with it. Because he didn't have a choice. And I think Greenspan was in an era that was just different. We had a declining interest rate environment, and it was between the baby boomers, home buying years, and the millennials, home buying years. So that demographic didn't have the same intensity of home buying for Gen X. So after the big baby boomers came through, there was a gap in demographic in terms of growth. And we caught up the home builds, and rates were already very high. But that doesn't necessarily mean that Volcker was the big deal in it. I think it was just the market going through an era. That's it. And we're going through another era now. And it doesn't matter if you put Volcker or Greenspan or Powell in it, they are all subjected to conditions and demographics in the system that they are forced to deal with. So they're not running the show. They are reacting to the conditions. That's all it is. Lawrence Leopard says, great chart from today's Doomberg. Maybe grabbing the Russian assets wasn't such a great idea. So Russian reserves, gold going up. And then Russian reserves in terms of US treasuries is declining. Now, I think this probably started from 2008 when we started printing a bunch of money. That's what it looks like to me. And then they show the chart of 2020, which is over here, which is the graph. So this was already in progress before that. They probably see what's coming. This is the TSX Venture Composite. It's working of a very large macro breakout. This will for sure give a lot of tailwind for the commodity sector and miners as this breaks out of this kind of falling three-hump consolidation. We hit resistance. We're trying to break out here, and I think we will soon. Now, a lot of people, they'll get frustrated. They'll say, Nvidia is still going up or something. It's like, that's not where you want to be, though. That's not where the value is located. Everything with value keeps you in the right part of the cycle. As things get more expensive, like technology stocks or Nvidia, if we were to say that, people will say, well, the feature is AI. It's like, yeah, but you don't pay up for it. You get out when things are expensive and you just buy crap that's undervalued. This is the chart that's coming. You want to go to where the puck is moving. And yeah, I played a whole bunch of hockey. Don't get me wrong. I played with some very, very good players. I think 5 or 6 of them went pro. And you go where that's a Wayne Gretzky quote, but this is where the puck's going. That's where you want to be. And why do you want to be there? Better risk reward. Nvidia has less risk reward than buying oil in 2020, than buying oil today. Oil today has a better risk reward profile than Nvidia does right this second. A true market leader, you can blow up your trading account even with holy grail trading system, but in proper position sizing, where you can make a fortune even with a weak system and excellent position sizing. So you must learn position sizing. That is a whole big deal. So, it's not about finding a one-trick pony into one sector with one type of company. And it's like, man, you're going to get blown up if things go in the opposite direction. The thing, you hear people like Stanley Druckenmiller say that they focus on a very small basket, right? What they do is they wait for an opportunity to present itself in the market where something is like, it's completely mispriced. And that's what they mean by putting a bunch of money into one idea. It's like you get 5 ideas, let's say, out of 5, 6, 7 ideas, out of the entire investing career, where you see something that just gets completely out of whack. And that's when you want to go big. They don't mean go big all the time. Like, for instance, 2020 was a weird situation for C19 event. Things sold off. They shut down the economy. It's like, man, if they open up the economy again, which they will, you just kind of have to time that bottom and go long massively. Then they printed a bunch of money. It was like, oh man, they're gonna fling this thing to the upside massively. But there was no inherent weakness before that economy was shut down. It wasn't like we were entering a housing market crash. It wasn't like we were entering a recession of some sort. Like, we were strong before it with home builds and all that other stuff. So the strength was there. But that's what you need to recognize. It's the conditions. That's when you go big. You don't go big when everything's gone up a billionfold like Nvidia and you're like, oh, I'm going to go big now. It's like, that's not the right time. So it's almost like it's impossible for people to understand his quote without knowing the markets already, is what I'll say. Imagine playing Monopoly and never buying any assets or investments that generate income. Imagine you just went around collecting $200, giving your money to the rich, and trying to stay out of jail. That is how most people live their lives. Well, think about that for a second. You can't win that game unless you buy a whole bunch of assets. That's what I'm doing. I'm trying to buy as many assets as possible, and then getting dividends, getting income, cash flow from them. Now, if you're playing Monopoly and you're just going around renting, you're going to get smoked. Now, people don't, I don't know, that's what people think. They're like, oh, it's cheaper to rent than it is to buy. It's like, okay, then just let rent prices run up on you then. I mean, I can remember when rent prices were like a few $100 way back in the day when I was growing up. I mean, they were like nothing. Now they're thousands of dollars a month versus a few $100. $500 or $400 of rent versus what it is today of probably 5 to 7 times that, depending on what you're buying or what you're renting. A house versus a one-bedroom little, apartment or something like that. So I agree. I think buying assets and then just never selling them is the name of the game. The clearest bet for this decade is energy. Yeah, he's speaking my language. AI, chips, data centers, robotics, electric vehicles, self-driving cars, none of them work without power. They all need electricity and a lot of it. You know what else we need? Copper. We need a lot of copper. You know what else we need? We need a lot of coal and natural gas. And if we use solar and wind, if they go down that path, we need a whole bunch of minerals. I mean, a gaggle of minerals. I mean, it all over the place. So, what do you think I'm going to invest in? I want to invest in the things that people need, but not the configuration. So, I don't want to go into the configuration like, AI and chips. Chips are going to be it's a race, but they need silicon, they need energy. Data centers. I don't want to invest in the data centers. I want to be in the things that data center uses, like energy. Now, coal, it doesn't matter what you burn it for. If it's electricity, it can be used for anything. So if we know that anything is going up, like electricity, then I just want to be in the crap that generates electricity. Natural gas, coal, uranium, which is nuclear. I want all of that. It just seems like an easier play. Earnings are the most deviated from their long-term growth trend ever. There they are, most deviated ever. U.S. tech stocks have reached a 100-year high relative to the S&P 500 in 2025, with the Mag 7 now accounting for 35% of total U.S. market capitalization. Tech versus S&P ratio here. 1970. Do you know also what 1970? That was the beginning of the commodity bull market. You know what the February of 2000 was? The beginning of the other commodity bull market. What do you think this is going to be? The beginning of the other commodity bull market. I mean, come on, guys. We're over 2 standard deviations away from this mean here. This is the time to get the heck out of tech and get the heck into commodities. Commodity bull market, and I am surprised we're this high. I thought we were going to turn, more so back here, but somehow it keeps getting ramrodded higher here. So Saudi 10.5, UAE 3.55, Iraq 4.5, Kuwait 2.8, Oman 0.95. What is that? That's their max capability here. This is where we are at the production. The only one that might be able to eke out some more is Saudi Arabia. Everywhere else, they're pretty much maxed out if you were to compare these numbers. They're very close to being maxed out. They may be maxed out. So what we're doing here, and people are like, oh no, they might increase production again in September. We are eating through world oil spare capacity. Once the spare capacity is eaten up, sky's the limit. Sky's the limit. So we'll see what happens when that occurs. And I think it'll occur soon. It's coming. China's economy expanded by 5.3% on the year in the first half of 2025, outperforming expectations. In June alone, industrial output grew by 6.8% year on year, signaling an acceleration entering the second half of the year. Outbound shipments jumped by about 6% from a year ago, exceeding Reuters poll estimates of 5% rise. Buoyed by the temporary reprieve from U.S. tariffs, cumulative seaborne arrivals to China climbed to 1.1% year on year, reversing the trend of declining imports. I wonder how much of this is dependent on tariffs being flicked on and off. Do you think they're trying to, I don't know, move the numbers in either direction, saying tariff on, tariff off? I don't know. Just curious. Freight futures AM update. Dry bulk down today. Capesize down 3%. Panamax down 1%. Tankers are up. VLCC up 2%. Suezmax up 2%. Instead of taxing the income of extremely wealthy people, they're taxing all of us when we buy things. They're replacing income tax with what amounts to a sales tax. This is tariff revenue. Now, I hope that's what they do. I hope that they replace tariff tax. They replace income tax with tariff tax. That's what I hope. I don't want this to be just additional tax. I don't want to have to pay income tax and tariff tax. That would be horrible. Now, a lot of people would say, well, that's unfair. No, it's not. It's completely fair. Right now, the system is unfair for people who maybe aren't the mega billionaires, but the people who make good chunks of money, like over $150,000 a year, maybe 200. If you make more than that, they're just raping you in terms of taxes. And then you have the whole bottom half that pays literally nothing in income taxes. Nothing. They pay zero. So I can't come up in my mind and say, well, yeah, that's completely fair. That doesn't seem fair. What seems fair is like a sales tax. So if you buy something, everyone's paying taxes. That makes sense to me. You can't have 50% of the workforce pay zero income taxes and then have the ability to vote more taxes on the people who pay the taxes. Like, you have no stake in society. I mean, that just seems ridiculous to me. So hopefully this replaces income taxes. Fingers crossed. I hope so. I don't want to have this be additional. And I don't know, I mean, this doesn't seem like I don't know if this is enough money to replace it completely, but Howard Marks says the relationship between price and value holds the ultimate key to investment success. Buying below value is the most dependable route to profit. That's the strategy. The AI investor, Nvidia, 76 to 78% of employees are now millionaires, with approximately 50% of them having a net worth over $25 million. Fun fact, unlike other big tech, Nvidia is not enforcing a strict return to office policy and instead embraces a flexible work approach. Do you think those Nvidia employees who are now multimillionaires, think about making money fast, that first quote. Would you say that Nvidia employees are skillful and knew what was coming in Nvidia? Or do you think a lot of them were just in the right place at the right time and luck was involved? So obviously those employees are skillful. I'm sure a lot of them are. And I think that, by happenstance, they were in the right place at the right time. So that is luck. Now, there's a bunch of other tech companies that probably don't have near the same net worth approaching 25 million. They're in a different company doing the same jobs or similar jobs, perhaps, but didn't have the same outcome. Is that skill or is that luck? That's what I mean by some of this. And they're also in the right place at the right time in the right sector during the right time frame of a tech bubble. I mean, it all worked out quite well. Now, if you can time, I think if you work for a company like a gold company now, I bet you it's a great time to enter into a gold company or a mining company or an oil and gas company. I think that's where the next cycle is going to create 50% of having net worth over 25 million. That's where the next cycle's coming. And that's all. That's where we're going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. Special is the coupon code. And that's all I've got for today. So we'll see you next time. This is Finding Value.